what we are starting to get to is data points and evidence that prove even further than what we've been talking about, which is for the last 6 months, which is that we are not in a 4-year cycle. And the further and closer that we get to the end of the year without BTC going parabolic, I think we're it's proof positive that we have broken out of the 4-year cycle. And everybody should probably readjust their expectations in a good way, because ultimately what that means, and my guess is that we will end 2026 much higher than we started.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today. But for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Bell Curve Roundup. You got Michael's 1 and 2, Vance. Fellas, how we doing?
Good. I'm reading some dude who tried to vibe decode Hyperliquid. Do you see that, Michael?
Yeah.
What is that?
I don't know.
What is vibe decode? I don't.
He asked Claude,
reverse engineer.
He asked Claude to rewrite Hyperliquid, and I've literally just read the TLDR section, so that's as far as I got right now. It's saved on my desktop, but I think he found some interesting things. Rajiv on our team was saying it was interesting.
What any notable findings or?
You're going past my understanding.
Yeah, maybe you shouldn't have brought that up on the pod, but I think let's put a pin in that one. Maybe we can start the pod. All right, welcome back to Bell Curve.
Missed you boys in London this week. It was a fun one.
You look very British, might I say?
Yeah, I got the I got the turtleneck. Have I ever told you guys my turtleneck story? It's a Das London classic. Yeah.
Let's hear it.
Well, I don't know. Well, yeah, I guess I started it, so I got to finish it. But yeah, one of these times when we had Das London, it was over the gilt crisis, if you remember that. So the pound, it was basically a parity with the dollar, and I was like, you know what, I should take advantage of this and go get a suit. And I had this kind of European sales guy who was kind of got me feeling myself when I was picking the suit out, and he was like, you should get this turtleneck. I was like, no, I'm staying in my lane. I'm not a turtleneck guy. Thank you, but no thank you. And he's like, no, you should do it. And I was like, yeah, maybe give it a little try. And so I got this turtleneck and I wore it for the, you know how when you try something new and you're a little sensitive to it, and I just got roasted. And one of our employees photoshopped a photo of me in this turtleneck with like a white cat, like looking like Dr. Evil. Anyway, so I've been off the turtleneck game for a long time. But
I'm glad you brought it back out. You look like a young Steve Jobs.
I appreciate that. Thank you. Well,
all right. Well, now that we've gotten off to a really hot start,
we start the pod for the third time.
Good. You know what? Actually, it's been a while since we've been a macro pod. I would love to get your guys' take on gold here. So gold is trading at just under $4,300 an ounce. And, there were all these, I'm sure you guys probably saw this on X over the weekend, but there are these queues around, in banks around the world, people trying to, lining up to get gold out. And, this is a part of me thinks this is like real fodder for the gold bugs who are like, just when you need the gold, it's not going to be there. And, but I will say for the last about year or so, gold was trading around 1,800, in between 1,800 and 2,400 an ounce, and it's really broken out. And I guess I'm just curious to get your guys' thoughts on this and what the implications are for crypto. Because Vance, I saw that you retweeted something from back in April that the bull market doesn't start until gold tops. So this could either be, the signal that the gold bugs have been looking for a long time, or it could be the start of the rotation away from gold back into Bitcoin and hence, the rest of the coins. So I'm just curious to get your guys.
Do we have like a long-term gold chart we can throw up of some sort?
Yeah, let me see if I can find one here.
So I found one, but I mean, the long-term gold chart is this one I found goes back to the 1920s. So I don't think it's gonna be that cool. But basically, gold was a thing after 2008 with a lot of big macro investment managers. And I was listening to this podcast, or not a podcast because those didn't exist at the time, but this interview with Stan Druckenmiller at the Chicago Economic Club in 2009. And his big thing was like, we're super long gold. And in 2011, I believe, gold peaked at 1629, and it started in 2000 at 267. A bunch of stuff happened in between those two dates, like the gold, the physical market really opened up. Like there was futures, there's all these ETFs. Those all opened up and it went up kind of 6x, but it kind of didn't do anything for basically 10 years. Like it kind of breached that high in 2020 of the COVID kind of crisis. And so I think if you kind of zoom out, the chart that goes from 2001 to 1700 looks a lot like the chart that goes from 1000 to kind of 4200.
Mm-hmm.
Probably like, that first period is like a 5 or 6x, and kind of like from the lows after COVID to the highs today, that's like probably a 4x. So that's kind of that move. But I think if you're buying gold here, it's like buying real estate in 2022.
Mm.
Like a lot of the juice has been squeezed. We're at 4,300, but after it tops, that's kind of when everything else can go nuts. Like the gold, the debasement trade, what is it debasing? It's debasing money. What is money going to debase? If you look at a KPI, like a way to evaluate stocks, it's going to debase the PE. The PE will just go up, right? Because if like nothing matters, then and if like funny money is better than actual US T-bills, like the PE will go up. I think it's a harbinger of kind of a risk rally. Maybe a blow off top. We'll see. But Trump's still got 3 or 4 years as president, and he's going to be cooking that whole time.
Yeah. Well, one thing I'd add is what we've historically seen is gold run and then Bitcoin follow. And I think that as the narrative of debasement is obviously hitting harder with people who maybe remember times where we had higher inflation and debasement, which is the older populations. And so, of course, gold is going to be the thing that moves first. And as the younger generation kind of gets off their AI, growth stock craze, I think they're going to look to debasement in the form of Bitcoin. And so my expectation is that what you're seeing with gold right now is probably a, forward-looking 2 to 3 month chart for Bitcoin.
Also, the other thing I would say is, so the backdrop of what macro, or at least US specific news has been, is this First Brands thing, which is this automotive parts supplier that just had like $6 billion of debt or money just disappear. And that ensuing bankruptcy, like Jefferies holds a bunch of it. They were their main financing partner. People are kind of waiting to see what happens there. KRE, which is the regional bank index, is down 7% today. Can we pull up KRE?
Yeah. Hold on, I got you.
I mean, the last time it was, it's kind of bounced around 40 to 60 for like 5 years, but there was this big drop from 60 to 43 when SVB blew up, and we're at 57 right now. So people are nervous about that. The 10 years below 4, people are looking at that, and they're like, okay, the Fed is going to start have to cutting. People are nervous about the labor market, which is another thing. So like gold is the view that this is pretty unstable. First Brands is pretty unstable. They're going to cut rates, and the US dollar will go down, which the end part of that is bullish. The rest of that is kind of like everyone needs to sit with that for a little bit.
The other element, we had some bankers in our office yesterday that I was talking with. Got a lot of tidbits, interesting tidbits. One of the things that they said is that you're going to start to see banks actually take back commercial real estate that they own the debt on. And so what you've had over the last 3 years is commercial real estate. We're talking about San Francisco in particular, but it's the case in Boston, New York, any of these areas that have gotten hit with even like 2 to 3 days less per week. Employees coming into offices means that you're going to value your property 20 to 40% less than what you did previously. And these commercial owners, real estate owners have been extending and pretending for years. And now the
Yeah.
banks are so capitalized, the large bulge bracket banks I'm talking about, not the regional, but because the banks are so well capitalized now, they can take on their commercial real estate where they own the debt, and they're not going to let these owners just kind of like roll their debt. They're going to say, hey, you actually owe us this debt. Like, we're calling your debt now, and if you can't pay it, we're going to take the keys and we're going to start operating this property. So I think that commercial is also something. I mean, in their eyes, commercial is something to be watching out for as well. It'll be a canary in the coal mine, but there's trillions of dollars of commercial real estate that's underwater right now, and that could be an interesting element driving this further as well.
Yeah. 2-year fell about 25 points today too. I saw, yeah, I mean, there's the cohesive story here, right? Is gold doing very well? Banks suffer. I don't know if you saw, there were a couple of like smaller regional banks, which probably is informing this, this KRE index that we're looking at, advanced, that you called attention to, but they flagged that they might be having trouble and actually bad debt due to fraudulent loans. So yeah, I mean, I think it's definitely an interesting time. And at the same time, there's this idea of the debasement trade, which, if you've been in crypto or following anything related to Bitcoin for the last, 5 or 10 years, you've seen lots of people tweet out charts around, S&P performance, not denominated in dollars, but in gold or in Bitcoin. And I started to see like guys like Mohammed Al-Arian tweeted this out a couple of weeks ago. And again, if you've been in this space, if you're listening to Bell Curve, you've probably seen these things 100 times. It's just interesting in the last, I don't know, couple of weeks, it's really picked up steam on Wall Street. So yeah, these are the
here's one more fun fact that this bank and these bankers who very investment bank, but also wealth management or asset management division. We were talking with them about crypto products and how and this is a 2-letter bank, one of the largest in the world, and has the largest or the most amount of assets under management that's managed wealth. So you can assume who this is. But just this past week, or in the past week, the bank shifted its allocation to 2 to 4%. And what they told us is that they now officially have the ability to not require clients request specific crypto products, but they can advise their clients to invest in crypto as well. And so previously what you had to do is you basically had to have a client who was, knocking on the door saying, hey, I want to buy IBIT. And then you have to go get special approval to do that. Now, these bankers, these asset managers can suggest to clients, hey, you should have a 2 to 4% allocation. So their prediction is that these crypto products, these that run through brokerages, particularly IBIT, are going to run off the shelves with this platform turning that on.
Let's go.
Yeah.
And I think like at different parts in the rally, and just so everyone knows, like, yes, we are permabulls, but we've been bullish since basically the bottom. Like, you're going to have these things, you're going to have these two assets, Bitcoin and ETH, fueled by different parties. Like, the lows on ETH were, I would think, put in by the American VCs back in the day. Then it was kind of the ETF catch-up flow that were crypto natives. Then it was the ETFs themselves. Then it was Tom Lee. And then I think there's this whole other leg of demand that people can't really see because, frankly, a lot of crypto people are not private wealth management customers of a place like Morgan Stanley. But that is where the big money is. Really kind of the only money that tends to matter. I do think also, just talking to not just these bankers, but other ones, everyone's, pretty, I wouldn't say freaked out, but a little nervous about just how much some things, like some stocks specifically, are up. Things like Oklo or things like even things like Broadcom. From the date that ChatGPT was released to today, Broadcom is up over 10x.
Look at Oracle.
Look at Oracle, look at AMD, look at NVIDIA, look at Nebius, all these things. And generally there hasn't been a lot of money to be made in public markets, but this year has kind of been one where retail, things like Rocket Lab that Tyler Neville talks about, the CoreWeave, like they've been on just this absolute tear because it is like this net new theme for the first time reflected in public equities. So I think everyone's on bubble watch, even like Andrew Ross Sorkin writing a book about the 1929 crash. I'm sure he didn't start writing it like 2 months ago, but everyone is just very nervous. It feels like, and all of this stuff is coming out at the same time, which means that it kind of can't possibly be the top.
Yeah.
There was also a fantastic tweet by Nathaniel, I think Wittenhouse. I can't. Whitmore. That's it. Where he said the Big Short created a decade of people trying to spot bubbles. Like there's an entire industry of people, and everybody is always constantly trying to just call the top, and run over.
And do you guys listen to the BG2 podcast?
Yep.
Mm-hmm.
Brad and Bill Gurley. Like, I'm sure Bill Gurley is actually going off to promote his book and do whatever, but I also think it's like, bro, you're too bearish for the show. Like, we're talking to Jensen last week. We're talking to the Ironclad, in 2 weeks. Like, there's no, like, he's trying to get in there and be like, hey, these transactions are circular. Just like, I don't want to listen to that podcast, and I don't think anybody else does either.
This episode is sponsored by Katana. Katana is a DeFi-first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. The other interesting part of that podcast, though, was Bill Gurley, who's been a skeptic on crypto for a long time, but he has been unhappy with with how public markets are functioning in the U.S. And has been very critical of companies staying private for longer and of mechanisms like IPOs. He's been like a huge proponent of direct listings, that type of thing. He's finally switching over to he's jumping on the crypto bandwagon, in his own words, which was pretty interesting. And the thing that has gotten him, just like just about everything else, is stablecoins. And he expressed surprise. By the way, I know it's easy also to kind of poke fun at people who took this long, but it was a very reasonable perspective to say that the U.S. wouldn't be open to this kind of stuff. I don't think that's totally unreasonable, but many people now are seeing it's just got critical mass. It's happening, and yeah, he actually pointed out in that interview. He was discussing the Real Now payment system that exists in Brazil, which has been very successful, implemented in other countries as well. But his hope was that stablecoins can actually achieve this in a more with a system that has more markets forces attached to it. And yeah, I thought it was super cool, at least, that he was really positive on crypto coming around. And just coming back from DAS this week and all these conversations, it's really stablecoins that has meaningfully turned a lot of sentiment around, at least in the institutional corner for crypto. I don't know if you guys feel the same, but I think it's
great to see them coming around. I do think there is like a conflating of what the opportunity is versus what the industry needs. Like, if your first take is that we need faster blockchains for the stable coins, like if the blockchains weren't fast enough, the stable coins wouldn't be on them, and there's 300 billion of them. So I think like it's not about remittances. It maybe part of it is, but a lot of it is about capital formation and lending and things like that. I think the other kind of take that I disagree with is just like the hyperscalers are going to get involved here.
I don't think they will. The AI is such a
tried and failed.
Focus. Yeah.
I think there's the first part of grokking why it's powerful, and then there's the second part of going deep from first principles about what is happening today and why that is not just it's not an existing industry. It's almost like a new customer basis as well. And it's a really complex topic with nuance. I don't know how to get people the last mile. I think the only way you can do it is really just kind of being on the bleeding edge of this technology and doing it yourself. Like, a lot of the stuff we do with Sky, I consider to be just like actual bleeding edge. So hopefully more people recognize it.
How do you guys think Zuck feels about watching stablecoins rip post Libra back in 2020?
I mean, he got shut down. It wasn't his choice to kill it. And
I know, but he's got to feel a little raw about that. He was just completely right. Just, timing was tough.
Yeah, but at the same time, he's focused on a bigger platform, which is AI.
Mm-hmm.
Yeah, I would say equally sized.
In his mind, he thinks. I think that applies more. It's a bigger opportunity for Meta.
I don't think it's a foregone conclusion that they would have been successful though.
Yeah, I agree.
It would have. Everyone deserves the right to try it if you're properly regulated. I think that was like the real tragedy. Is just was that Biden or was that Meta or was that
That was Elizabeth Warren.
Right. I have so much PTSD from like that. It's just like I don't even remember what happened.
Yeah, I've got a question for you because it's been to your point, it's not a foregone conclusion that they would have won, and there are some very big entrants already in the stablecoin market that haven't really done anything.
Look at PayPal, who printed 300 trillion Pi USD yesterday. Look at them. They're just soaring. No, in reality, I think you can't necessarily force your customers to use a stablecoin unless they really want to. It's got to be a natural conclusion, and unless you're doing it on the back end and it's something that isn't consumer facing at all. So it remains to be seen whether or not any of these platforms that have mass appeal and adoption from a consumer perspective are actually going to be the use case that people want stablecoins for, or if it's going to be some organic kind of natural crypto-led, crypto-native approach that wins.
Yeah, go Vance.
It's going to be crypto native and futuristic in ways that people will not understand. In the same way that they do not understand what Tether is doing, and they kind of almost make fun of it for having like 13 employees. It's not a traditional business in the way that they've been described. It's somewhere between like a mutual fund, a PE shop, something that has multiple domiciles, and maybe something that never goes public either.
And in all technology markets and with all new technology products, sometimes it can be, but it's not usually the incumbent who wins. It is usually, and this is called the innovator's dilemma, but it is usually some new approach that happens outside of the incumbent, just because the incumbent can't cannibalize its own business to move in this direction. This is why the startup ecosystem exists.
So for instance, like Daylight. This is an example of something that you are powering with a stablecoin. You are taking battery and solar deployments at a time where basically all government funding has been pulled for this. It's still a viable energy source. It's still cost effective. It's still profitable. You wrap it in a stablecoin, and then you finance it with traditional private equity, other stablecoin, other asset manager balance sheet. Like that concept, like think about like USDAI wrapping GPUs in stablecoins. This is so far away from the remittance use case that people think we're sending around these $300 billion of stablecoins every day to like our families in other countries. Maybe some of it, sure. But like most of it is this interesting capital formation idea that has not been even like adequately named yet. The one that I've been playing with, the branding is just agentic lending. Like if you're able to print currency, manage risk, manage complexity in real time, that's like we're starting to get into orbit with like how interesting stablecoins are.
But as an example with Daylight, the reason why you wouldn't be able to have that exist by an incumbent is because a utility would have to destroy its own business to build Daylight. And this is where the rub is. You can't have something that you have a core business that's making money, it's paying everybody. You've got shareholders, maybe you're publicly traded, you're reporting that out. You can't say, hey, we're going to get rid of this business that we're doing, our entire purpose, to do something new. Or if you do, it's insanely difficult, and you probably have to be a founder to do it. Look at what AI and Gemini is happening with Google. You're going to kill the search business unless you can slowly integrate AI into the core business of Google. And the core business of Google makes tens of billions of dollars of profit each year. I think it's about 75 billion. So it is extremely difficult, if not impossible, for you to disintermediate yourself in lieu of something new. And this is why Pi USD doesn't have any volume.
Yeah. Okay, I've got a question for you guys. So I completely agree that it's innovator's dilemma. But one thing that I was trying to reason with is that there's going to be a whole bunch of new issuers that come and try to issue stable coins and win market share. And the natural thing that it seems like all of these new entrants are doing is I'm going to give away all of the yield that I'm currently earning. And they have different strategies about how they want to do that. They want to find clever ways of rebating it to the holders of the stablecoin. They are trying to give some of that to lending protocols to incentivize them to distribute it. But all of it has the same kind of net effect of driving down borrowing costs. And, if you think about $3 trillion of, this is Scott Bessent's line, right? Let's just say $3 trillion or so, 2.7 trillion of net new stablecoins coming on chain in the next couple of years. Shouldn't that almost that should drive down borrowing costs on chain just because of the amount of rebates that people are getting, right? I hadn't really put two and two together until this conference, but it was just a conclusion that I had coming out of it.
It depends though, because if you've got the $3 trillion, they have to be backed by something. If this is a Genius, compliant, which we would assume a Genius compliant, that's just yield that's on chain. Why does it have to compress? I think what actually matters is where's Fed funds, because that's what determines what the yield is that you can earn with these stablecoins.
Yeah, that's a good point.
I mean, the hopeful long-term view is we can actually build out a yield curve that the Fed uses on chain, where they sell new issues, retire existing ones, and raise capital for the U.S. government. I think you can do interesting things with incentives, like what if you gave all the stablecoin issuers additional units of yield to stay at the short end of the curve? Okay, what if you then redirected that to the long end of the curve? You could do, when you hear about how people who trade government fixed income, especially US, it's just like 5 or 10 dudes. Like, you could probably fit all of the people that trade these things in a small conference room, versus putting that all on chain. Like, there's efficiencies that you can squeeze out of this system by adopting it. Is that going to look like a business to a lot of people? I don't know, but there's a huge amount of consumer surplus you can generate with stablecoins, and also what that backing eventually gets put into is interesting. Is it things like Daylight or things like USDAI or financing uranium carry trades? There's a world of also other countries' currencies you could do this with. I think it's going to get really interesting in the next couple of years as we scale to trillions. That's the base case.
Agreed. And I think a huge part of this depends on what the opportunities are to redeploy that capital. But, Michael, to answer your question about why it might drive down yields, dependent on, whatever Fed funds is, or, SOFR or whatever, is even being able to borrow at SOFR or Fed funds for most people is huge. Almost no one can do that. And the way that I could see the flow of funds here moving is, let's say I'm a new stablecoin entrant and, I'm trying to win market share. So I go to a bunch of borrow lend protocols and I say, I'm just going to kick all of this yield back to you. So what do you do? What do you charge people to borrow against that? I think most protocols are not going to be super greedy. And if you're getting all the NIM from that stable coin, you're not going to put a huge margin on top of that. You're probably just going to say, look, I'm getting Fed funds here. I have no costs. I'm just going to let people borrow at this rate. And then I think, big arbitrageurs will then borrow that, redeem it or trade into something else that they can, deploy at size and basically use it to lower their cost of capital. But it's kind of like a long trade that I can see happening over time. I'm not saying everyone will do this, but yeah, I hadn't really, again, put two and two together there, that it won't all happen like that. Not everyone's going to do that, but I do think new borrowers or new issuers coming to market, kicking back some of those funds to everyone else, it kind of has this dilutive effect on.
Yeah, more supply and competition is going to drive down what that NIM margin is.
Yeah,
I don't disagree with that at all. I just think that there's a much bigger difference in borrow costs when we're at 5% Fed funds versus 3%.
Shout out to today's sponsor, Katana. Katana is a DeFi first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into Vault in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. Everyone in crypto loves to talk about transparency, but would any serious business publish its payroll for the world to see or hand competitors its contracts? That's not a feature. That's a bug. And it's why most financial institutions can't operate on today's public rails
Canton Network is different. It's the only public permissionless layer 1 blockchain built with privacy at its core, sharing data only on a need-to-know basis. That's why Goldman Sachs, NASDAQ, and BroadRidge are already building on the network. Only Canton delivers the network effects of a public chain with the privacy and control real finance demands. Learn more about Canton by following the link in today's show notes. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Can we talk about, we were supposed to chat about this last week and we missed last week, but I would love to get your guys' take on just the pretty historic liquidations that happened on Friday. So that was October 10th. We saw some $19 billion getting liquidated. It seems like it seems like in grand terms, the culprit here was just what it usually is, which is too much leverage. Zooming one layer down, it seems like what Binance ended up doing with several key pieces of collateral, USDE being one of them, is they changed the way that their Oracle worked to only reference their own book. So rather than referring to the cost of, or to the price of USDE where it had the most liquidity, which I believe was on Curve, they only referenced their own book. So it kind of caused this negative self-reinforcing loop to go down. And that just kicked off a bunch of selling across a whole bunch of different assets. I think you guys would know this number better than me, but something like 7 billion or something like that was also liquidated on Hyperliquid. A lot of people learned the phrase ADL for the first time. And now that we've got about a week in between us and this event, we can see initially the markets recovered. This also happened on like a Friday night. So the ETFs weren't trading. That made it more challenging. It looked like going back into Monday, the market recovered pretty nicely, but it's been trading sideways to down. I think Bitcoin's back under 110K. Curious to get your guys' take on the functioning of markets. The very positive spin would be we liquidated 19 billion and we're all still standing. That's never happened in crypto's history before. That's really, really positive. The negative would be we've still got some ways to go on market structure here. And the market hasn't recovered maybe to the degree that we would have liked, at least on some alts. So I'm curious what your guys' take is on all of
Look,
this stuff.
no official evidence to suggest this, but it does feel pretty. If I was a bad actor and wanted to cause cascading liquidations and maybe have some shorts on, seems like a pretty good way and a pretty good time to do it. And I think, so what does that mean? It means it's not, the organic market saying, hey, we're done with crypto, we're selling out. It's someone who had knowledge about how the Oracle works at Binance and wanted to mess with it. And I do think that it's good that we got all this liquidation kind of over. We were on the roll up earlier this week, and one thing that I talked about was typically you see like the day after there'll be a retest, or like within 24 or 48 hours there's a retest, but then there's also a retest in the next week typically. And I think that that's generally what we're seeing right now. It's just that there's a lot of, and it's not just crypto right now. It's like all the AI stuff is selling off right now. All the nuclear stuff, like anything that's sort of been in a growth trend the last few months is selling today. And so maybe it's just a general de-risk. I do think that what we're starting to get to is data points and evidence that prove even further than what we've been talking about, which is for the last 6 months, which is that we are not in a 4-year cycle. And the further and closer that we get to the end of the year without BTC going parabolic, I think we're it's proof positive that we have broken out of the 4-year cycle. And everybody should probably readjust their expectations in a good way, because ultimately what that means, and my guess is that we will end 2026 much higher than we started. And 2026 will be a very positive year for crypto, as we're talking about. And aside from Dan Morehead, we expect that we're going into a rate cutting cycle that will widen credit spreads, which DeFi will be the biggest benefactor there. Stablecoins will be the biggest benefactor there. We think that crypto, in particular Bitcoin, will further the debasement trade like we're talking about. And there's just going to be so many new opportunities with, frankly, a lot of funds, a lot of our peers raising right now and coming back to market. And so there will be more kind of venture opportunities, I'd say, coming soon. So I would I would generally say like the world is positive for crypto right now, and things like market structure, Clarity Act, however that gets done, I think generally that will be another data point as well. But I think we are getting closer and closer to the end of the year, proving that the 4-year cycle is done.
Yeah, I mean, there's just absolutely hilarious headlines hitting my timeline as I listen and look at it. Apparently, one quantum stock today crashed 25% because there was a S4 filed that stated that the CEO had liquidated all of his ownership of the stock. Like, this is kind of the Bears Christmas day where you have it's like all the fixed income goes like below 4, the 10-year goes below 4, gold is up, the regional banking index is falling apart, JP Morgan's falling apart. I think the next part of this could be like a slightly hot inflation print and then a cut into that, which will kind of just send the message that like, yeah, inflation will still be below 3 if this inflation print is where Cleveland Fed, maybe we can throw this up, says it's going to be. But like, this isn't going to derail any rate cutting. So it needs like bad news needs to be bad news, and then it can be good news. Oh, Jeffries is down 13% today.
Wow.
Like things are getting hooked. So I mean, I said this on the roll up, but like the day that the sell off happens is not the time to like reevaluate your portfolio from first principles, or like or like finally do the research that you've been meaning to do. Probably not this day, maybe it is a later day, but I kind of see this as a garden variety, just like correction. And I don't think that 4-year cycle is necessarily real. I could see it being real, but I ultimately don't think it really matters if these larger trends are playing out. Once gold tops, I would assume that risk assets start to rally. And by the way, like we don't really focus that much on the day-to-day vicissitudes of the market. It's fun to watch. We have a lot of crypto. We think it's going up, but like most of our day is spent doing venture. Like it's fun to comment on this stuff because like we don't really kick it around too much internally. But I think things like daylight raising, things even like Jito raising, like there is a fundamental bid here for some of these coins at some point, and I think we're approaching the level of outflow tape that would actually generate bidding in terms of the prices being low enough on most alts. Not most alts, most high quality alts.
I was speaking to a guy who is very, very bright. I'm referencing a lot of conversations that I had in London this week, but very, very bright, but you'd call it pure trader. And it's been in crypto for 8 or 9 years. And you said something which made me think, which was you didn't actually need to know fundamentals at all for the vast majority of crypto existing. Didn't matter, wasn't relevant, didn't impact price, charts, anything. But now you kind of do. And if you look at the coins that bounce back the strongest after that sell-off, it's the ones that do have fundamentals and the ones that didn't, wick down 80 or 90%, and then they only rebounded, back up 20%. So even from a trading perspective, and if you were very, you don't care about, long-term investing and you're only in it for a short period of time, that's even fundamentals and real revenue and value capture starting to impact even those assets and investors with that profile. So
Totally.
that's interesting. Yeah.
Like it's back to basics, guys. Build a business.
Also, like Jito raises 50 million today from Andreessen, and it's down 1.5%. Like,
but that's as the rest of the market is down. So like,
but go for it.
No, I was going to say, I think I think what that represents is just frankly like there are there are just a lot more buyers in the market that are going to come out in the same ways that we saw in previous years. And I think things that have fundamentals and will have flows back to the token will survive, and you're going to get attention and excitement from large buyers like Andreessen.
Yeah.
Can I get one more question for you on just value flowing back to the token? Something that I saw get brought up on Hyperliquid over the course of the last week, outside of just FUD, was there was an idea that, okay, so when you're running a perp dex, you have multiple different sets of stakeholders. You have your traders. You have, in the case of, you have the exchange itself, the P&L of the exchange, and then you also have, in the case of Hyperliquid, HLP. The people have LP'd into that vault. And when there's a loss, there is, to some extent, a bit of a decision around who has to eat that loss. Because perp trading is a little bit zero sum in the sense that it's not real coins being traded. Oftentimes you're kind of zeroing things out. It's synthetic, the exposure. And so there was a little bit of a question that I saw, or a debate around, Hyperliquid actually had one of its best days ever, on the same days where many of its traders got ADL'd and HLP vault LPs were relatively protected. And funnily enough, this came back to the buyback. And there was a question of, should all of the revenue that Hyperliquid generates, should that all go towards buybacks? Should you actually make some traders whole with some of the revenue that you earn? So actually, I saw Binance didn't cover everyone, but they put 700 million or something like that towards people that got kind of unfairly or harshly liquidated on their exchange. I'm just curious, what do you guys think about that? Would you be in favor of redirecting some revenues towards making traders whole? And how do you view about that trade-off of those different stakeholders in a perp dex?
Giving people helicopter money is never the solution. I think best practice here would be, if you know anybody that was directly trading that collateral and can tie them and tick them to the P&L, sure, maybe do something on a more bespoke basis. Like we know has happened in the past, by the way. So this isn't like anything new other than they're really kind of publicizing it and making it much larger. But I think the framework for like good faith acting in this industry is like, think about like the BTC USD cross. There's the numerator and there's the denominator. You should really regulate the numerator. You should figure out which assets make sense, but you should generally kind of be you should allow people to trade whatever numerator they want. When you think about the denominator and you start changing that around, then you get really crazy about, like, can it be USD1? Can it be USDE? Can it be BN Sol? Are you trading crosses with rehypothecated collateral? Like, you really kind of need to just not even regulate the denominator, but shut it down such that it's only 2 or 3 assets, because people can lose tens of billions of dollars in an instant if it's not. And people will ask us too, like, why is USDS not like a quote asset? It could be, like, you'd have to build up a lot of liquidity. It's fairly easy to get these things crosses on these exchanges. Generally speaking, you just have to pay. But the question is not can you, it's more should you. Can you guarantee an environment where your asset does not depeg? Do you have enough liquidity? Obviously, if you're a subscale stablecoin, you don't, so you shouldn't. And it's not about like your like elite business acumen. It's about the realities of the liquidity around your asset, and allowing people to do it doesn't mean you necessarily should. So I think that's kind of more of the long-term lesson for these exchanges. And as Hyperliquid gets into different quote assets, it's a big thing.
Yeah, Mike, to go back to your question, I would say it all depends on what happened and sort of the cause of the issue. Like in the case of Binance, I think it's clear it was their fault, so they're paying. But if it's not something that's driven by an error or an issue with the platform itself, I don't think. I think you set potential moral hazard when you start paying back for losses, because then you have to ask the question: what's the defining characteristic?
I think it's the perception of fairness, right? That would be my, kind of overgeneralization response to that, which is, at the end of the day, if your customers don't think it was fair, even if you spelled it out to them, then it's just a business decision. I'm not sure. I don't know. I'd push back a little bit against the words. I'm not sure it's like as much of a moral thing as it is for like taxpayers picking up the bills for bankers taking too much risk. But I agree with you. I don't think you should give handouts to your customers, otherwise they'll expect it. But it seems like in the case of at least Binance, they had they explicitly just made a mistake. And so, right. Yeah, you probably don't want to just piss your customers off. You know what else?
I think Binance are in two different situations in this situation. And if the tables had been turned and it was an issue with hype, which it wasn't, I think that they would ameliorate it just like they did with Jelly Jelly.
I love that we can bring up Jelly Jelly and just shame Sam Lessin a little bit for his foray into meme coin.
Again, it's a question of should you allow people to trade daily 50x leverage? And when something happens, you shouldn't be surprised.
Okay, I've got another question for you guys on. So I don't know if this was ever officially confirmed, but what people were talking about was the Athena and Guy procuring ADL exemptions on assets like USDE. And, I think a lot of people have a pretty gut reaction to this, that doesn't seem fair. But good on Guy, like, can't fault him, right? That's just good strategy here. If he can get that, he probably should try to. And I that's generally the camp that I fall into as well. I am a little bit surprised if that's true, that exchanges would comply with this, or is there a steel man for the other side of this that I'm not seeing? Because if you have ADL protected assets, then it should lower the threshold for getting ADL for everyone else, right? Because exchanges don't want to, going back to this, having to there's kind of this hot potato of, when there's a trading loss, you have to socialize it somewhere, and the exchanges don't want to eat that themselves. So if you have a bunch of protected assets that can't get ADL'd, everyone else's threshold has to be lower, right? So I'm curious. That was the argument that most resonated with me, where it's like, this just doesn't seem like it's in the business interest of the exchanges to do this. But I'm curious, what do you guys think?
It depends on what type of business they're looking to do. We know that they take massive fees for listing, as was discussed publicly. We know that those go to their users, as has been discussed. And maybe it's part of negotiating for those transactions. And they say, we want 5%. And Guy from Athena, don't know if this is the case, but let's say a guy from Athena says, great, I want to exempt my asset from ADL if you're going to take that large of a listing fee. I think that the answer here is, if this is true, it's just even more dangerous than we previously thought to trade on these centralized platforms.
Does everyone have ADL? Let me answer that. Not possible. Okay. Because someone has to have ADL.
Well, ADL protection, you mean?
Right. ADL So does everyone have ADL protection? No, they don't. So what that means is the people who don't have it are going to get ADL even harder.
Right.
When shit pops off. And so
you
need to disclose that to people, because it's not like you signed up for the junior capital tranche of the perp trade that everyone trades. You thought you were just in the same boat as everyone else. That's not the case.
Look, I maybe just like a broad sweeping statement. It feels like patently obvious to say this. Outside of March 12th, 2020, I feel like it's just DeFi over CeFi every single situation since then. That was the one situation where, Maker halted, the Ethereum wouldn't process transactions. Like, that was also 5.5 years ago, and everything's come much further since from a technology perspective. But every single situation, it's like, oh, Binance messed up. Well, Hype was fine. Oh, FTX allowed SBF to steal all the money. Oh, well, everything on chain was transparent and fine. Like, it's kind of a question in my mind. And one thing I was talking about yesterday with our here is, like, when is everybody else going to realize this? Like, is it going to take truly 1,000 paper cuts, or like, is there going to be something that flips it eventually?
I mean, someone just got their head paper cutted off in that fraction.
Cut for sure.
Like, what happens when you get liquidated? Nothing. Literally, it's just like the money's gone. There's no like customer support. Maybe Binance hits you up, but like nothing's going on. There's no recourse. And I think maybe this is the time where the industry finally kind of says, you know what, that's it. There's been this massive, I think it was 27 billion came out from Binance. And, if I could just like guess about what was going on, Athena has ADL. I would guess the Jane Streets of the world have ADL protection. Like anybody who's like 3 to 5% of open interest probably has ADL protection. Add all those up. I don't know, maybe it's 50%. So 50% of the OI is just like naked when things really pop off, and absorbs disproportionate amount of losses when they do. I think retail maybe doesn't understand that, but the pros do. And I think the pros are not saying, oh, we just have ADL protection, we're fine. They're saying this is pretty sketch.
Do you remember who also had ADL protection, or the equivalent of it, on FTX? Alameda.
Sammy Trad.
One thing that we didn't get to talk about last week, but I'd love to get your perspective on is, and this was a big theme of the conference this week as well, was just combining of equity markets and crypto markets happening in the form of DATs, which Tom Lee said the DAT bubble has popped,
Over.
although Bitminer is still chugging along. We also have...
Ladder. He's just like, yeah, guys, it's over. You should go home.
That's actually, I respect that strategy. We've had more IPOs, but also we didn't get to talk about prediction markets. There was a massive investment from ICE, $2 billion into Polymarket. I can't remember the number, 300 or 400 million from Sequoia into Kalshi. Polymarket now has a $9 billion valuation. They've leapfrogged. Earlier this year, there was a raise that valued Polymarket at half of Kalshi, and now it's flipped. Kalshi is now 5 billion, Polymarket's 9 billion. I don't know if you guys have the scuttlebutt on what, is it metrics or whatever it is that underlies that, or if it's just they got this unbelievable investment from ICE. But yeah, just curious.
I still have serious doubts on whether either of these are real businesses. I love Polymarket trade there, but like, is there fees and earnings and profits and all that stuff? Like, I think it remains to be seen. But if it gets enough branding, maybe it doesn't matter.
Yeah, I prediction markets are a fundamental innovation. They're going to be integrated into consumer apps. I think there's an argument for them to be integrated into news. Like they will exist. What is the business? We don't know. Is there billions of dollars of shareholder value, tens of billions at this point? It remains to be seen. But I think prediction markets are going to be a really interesting and staying power, and frankly something that crypto can point to and say we built this.
Yep. And I think the same list of questions where it's like Robinhood, are they going to build their own and kick Kalshi out? Like, is it going to be incumbents or new people?
Yeah.
I think prediction markets is more of a commodity product. Like, do you care if you're long the Trump yes market on Kalshi versus Polymarket? Probably not. Just like best execution and distribution is what matters.
Yeah, liquidity is going to be the difference. But in the same way that I think you're going to see a lot of competitors, I think you're going to see routers that can pull from anywhere.
Yep.
Yeah. The one thing that it seems like Polymarket has, and potentially why I think, Michael, you just said this was brand, is, look, I'm not a exchange specialist or anything like that, but I do have perspectives on news, and I'm very bullish the idea of prediction markets and the role in news. And it's very interesting to link liquidity on an exchange with veracity of news. That's a cool concept, and I can see the winner, whoever wins that and has the brand of being truthful by leveraging markets, as being potentially enduring. So I don't, but you're right. Yeah.
But I mean, from a news perspective, I guess my question for you is like, have you found any enduring use cases of prediction markets?
I think you can start to see glimpses of it, but it hasn't materialized in a way which is, in your day-to-day use yet, right? Like, I mean, I think people are following Polymarket when the Trump election was happening back about a year ago. There have been weird ones that it's gotten right, but I agree it's still in its like really early stages. So I think if you were underwriting this, you would have to take into account exactly what you guys are describing. Is there real value capture here? Is there a massive business built on trading fees? I don't know. Maybe not. I think you also, it's unclear what the interaction is going to be even around news, and who's going to be writing stuff around it. Is it going to be AI or whatever? There are a lot of questions that you still have to underwrite. And I do agree too that there's the risk that this could all be folded into a larger exchange that has liquidity already, because this everything exchange model that now has come out of the mouths of every exchange operator, Paul Atkins from the SEC, I think people do see a convergence in historically separate models of brokerage, exchange, different types of exchange, sports gambling. I think people think that's all going to converge into, one brand and product. So it's all up in the air. I don't know how it's going to go.
It doesn't need to be Robinhood in the same sense that LLMs are a pretty commodified business, and OpenAI captured lightning in a bottle, got distribution in one. Doesn't matter that there's someone else with a better model. It already happened. Like, it's already on OpenAI. Like maybe that same thing could play out with Polymarket, but I mean, I think Tarek said they're at 40 billion of yearly volume annualized. If they're taking 10 bips or 20 bips, that is like 50 to 100 million of revenue. And then that's assuming that all of that is fee paying, which I don't think any of it is today. So a lot of distance between here and there, but I would love for someone who is not Robinhood or JP Morgan or Coinbase to win. That would be great.
I was talking to Yano today. He was saying that he's looking at Polymarket and using ChatGPT to look at the odds and see where there are discrepancies and like just do a little punt around money on that. I will say, if I had to take a bet on something that's mispriced at the moment, you can do odds already for the 2028 election, and Trump is at 3%. Not that not a political podcast, not that I'm voting for this. I think that is the wrong percentage. And I would bet that at the very least, there will be some sentiment increase that he might run, or, some people would be worried that he's going to run or whatever. I don't know. I just think 3%. I just want it on the record. Although this is not financial advice. Sorry, let me say that. It's not financial advice.
I think that would melt people's brains. If his odds moved to 10%, like CNN would be just thrown at absolute conniption. So
I mean, yeah, in that situation in particular, it's like, what are the odds that you can get a congressional amendment?
Again, will he versus should he?
Right, yeah, exactly.
Right.
But I have the Trump 2028 hat, so.
Apparently, people have been sending those around.
Those really would people out. Not that I even want that, but just like people lose it when you have that. It's just, trigger.
So I went to Turnberry last week, Trump Turnberry, the course that he's got out in Scotland. And, the Scots, just like Europeans in general, are, very, well, they're not a quiet people, but definitely appreciate old architecture, being proper and all that kind of stuff. And Turnberry now looks almost like you smashed a Florida golf course down in the middle of Scotland, which is a sight to behold in itself. But you go into the golf store, the pro shop, and it's all just like "Make America Great Again" hats. And just in Europe, that's a very funny. It's like USA and "Make America" like MAGA hats when you walk in, and I mean, you just gotta laugh, right? It's just I'm just imagining what everyone is thinking when they're walking into that. But yeah, it's quite funny.
Pissed.
Yeah. And in other pissed news, Ron Conway stepped down from the Benioff Foundation or the Salesforce Foundation because Mark Benioff came out in support of Trump.
Really?
Punching air is
Dude,
describe that.
What happened to you, Ron Conway? You used to be based. I mean, look, sent in the National Guard to San Francisco, which is what's under consideration. I think that would be just about the highest ROI investment that you could make as the president of the United States. The people who are building technology, you literally should protect them.
Yeah, but I mean, as we were just discussing, have you felt unsafe in San Francisco lately?
No, but that's because we don't live in the shitty parts of San Francisco. There's wild shit happening in the Tenderloin all the time. They need to
that is literally below your line.
Literally, I mean, we were just saying, crime don't fun.
That has truly been the case since the 70s.
Dude, since the beginning of the city. But I think it would be very interesting to see the National Guard in San Francisco. It's, first of all, not a very big city, 7 miles by 7 miles. Like, there's not a lot of actual space for a National Guard, whatever, like battalion or platoon to just post up.
I honestly think he's just working off of information that was probably originated from a perspective of 2022.
Yeah, it seems like it's lag. AI's got to be fully driving that city back. I mean, we didn't talk about this. Is sometimes a macro and AI podcast. We didn't talk about it, but yeah, it's got to be.
Look, as we were discussing, $6.5 billion of OpenAI secondary. It literally was sold in the last few months, and it hit bank accounts 2 weeks ago. Like there are 2,000 people that work at OpenAI in San Francisco.
Not bad.
Yeah,
not bad.
People are feeling good here.
Feeling good, feeling great. All right, I gotta end it.
All right, fellas, let's call it. I'll see you boys next week. Have a good one.
Later.
Yes.